Here it is. Now, first of all, we should understand. I think Jules have a question. He raised his hand. Jules?
It seems the chat box is disabled from my side.
Yes,
The chat box is disabled. Is from your side? Or,
yes,
or is,
I can see your chat. I can see your messages.
but it is disabled. Cannot write in. Cannot write in. I don't know if you configure like this. I don't know.
Actually, I write here hi in chat side. Everybody see it?
Yes, I see, but me cannot write. It say chat disabled.
Okay.
I don't know
Antonella,
why.
is there a feasible way
Let,
to?
let me see because I don't think this has happened before.
Mm, mm.
Yes, this is the first time for me as well.
Maybe otherwise it is my side. Maybe my problem. I don't know.
No, it says is in everyone can chat with the host and co-host.
Well, maybe it's from my side. Maybe. Okay. Anyway, thank you.
Okay, I don't know the reason, but uh, in the worst case, Juliet, at the end of the session, I will give the microphone to you. No worry about it. Okay. Now, let me reflect my screen again. Here we are. I think everybody can see my screen right now. And when we speak about the FX market, we should understand first this one, the XY. What we mean by the XY? This is dollar spot exchange rate. Okay, this is dollar spot exchange rate all around the world. This is an index. 100 is a benchmark for it. And if the value is above the 100, and if it is increasing, meaning that the United States dollar getting strength against the major currencies around the world. But if it is dropping and decreasing, and especially below the level of 100, this means that dollar losing the strength or dollar depreciating. How this index is calculated? Please look at this list. There are 6 major currencies in the dollar spot basket: Euro, Japanese yen, Great British pound, Canadian dollar, Swedish krona, and Swiss franc. These are the 6 reserve currencies all around the world, and countries in their central bank hold this money as a reserve currency. What we mean by reserve currency? If you go into any other countries around the world, you can directly change that money, even in the market, even in the spot market, even in the bank, everywhere. But let's say like a Zimbabwean or Kazakhstan tenge. These are non-convertible money, and you cannot hold those money in their bank, in their account, or in their central bank reserves. For that reason, for these major currencies, we are calculating a dollar spot exchange rate, and as I said, the 100 is the benchmark for it. And weight of this basket is approximately 60% coming from the euro, 13% coming from Japanese yen, and 11% coming from the British pound. So these 3 major currencies, euro, Japanese yen, and British pound, approximately constitute 80% of it. So here you can see its movement for one day. For instance, the current price is this. It is decreasing open this value during the day. The intraday chart showing that it is highest value is this one, lowest, and this is the time for that. Now, if you understand what we mean by dollar spot exchange rate, then we continue how this dollar spot exchange rate moving all around the world. And let's continue. Here, this is the DXY. This one, okay? This one now converted into a chart from 2000 till now, approximately for the 25 years time frame, and this is the value of dollar spot exchange rate. From 2000, as you see, dollar spot rate approximately 120, meaning that 20% appreciation of United States dollar against those 6 major currencies. And when we entered the global recession, global financial recession, global financial crisis in 2008, the value dropped approximately 75, meaning that United States dollar losing strength against those 6 major currencies approximately 25% less value against those currencies. And after the central banks start their quantitative easing policy, the dollar spot exchange rate get a balance and has a recovery process and reach the benchmark level of 100. And now in 2025, this is the COVID financial crisis, and today it is around 100. So the question is this: how this dollar spot exchange rate moving? What is the driver of this one? What can be triggering point of the dollar spot exchange rate? There are two things. The first is the trade balance, the current account balance. And the second thing is financial market interest rate returns. Let's focus on the first one. Please think this. You have a two country, okay, let's say Turkey and Russia. And let's say Russia sell products $1 trillion to Turkey, exporting $1 trillion, but just importing, let's say, $50 billion from Turkey. This means that Russia giving trade surplus to Turkey, right? Because they are selling $1 trillion, but they are importing approximately $50 billion. So what the Turk or basic manufacturer of the Turks on the market, what they need to buy those 1 trillion goods and services from Russia, they need Russian currency, right? Russian ruble. So if you buy Russian ruble and if you sell the Turkish lira, then Russian ruble appreciating against Turkish lira and Turkish lira appreciating because you need to buy Russian goods and services from Russia. So do you understand now why the Trump administration always underlying these 2 points? China giving the trade surplus against the United States approximately $350 billion, and we need to close this trade gap. Why? Because to buy the China's goods and services, you are appreciating the Chinese currency and depreciating the United States dollar, right? So because you should buy something from there, because if you want to buy something from those countries, you need their currencies, right? For that reason, one of the points that triggering the dollar spot exchange rate or any currency between two countries, the trade balance, trade deficit, or trade surplus. These can be triggering points. The second one is this: the interest rate between the United States and international 10-year yield. What we mean by this? Let's say Jules Haba living in Kenya. Let's say it is their original country. And let's say I'm in Ethiopia or Egypt. If I increase my interest rate increase, okay, the policy rate of the central bank increase, this means that my interest rate compared to the rest of the world now higher. And money always like the return. So international capital goes to the Kenya to get those positive returns, interest rate returns. If the money inflows to Kenya, then there are lots of dollar, euro, Japanese yen coming to the Kenya, and they are selling those currencies and buying Kenya currency. Then, because you sell USD, euro, or Japanese yen, they are depreciating, And because you buy Kenya currency, it is appreciating. So if you give higher interest rate compared to the rest of the world, your domestic currency, your home currency will appreciate against the rest of the world because you are giving return for them. You are giving an opportunity for carry trade for those countries, right? They can have a chance to make a carry trade to benefit from those positive interest rate return because the interest rate, let's say 2% in United States, but let's say 10% in Kenya. Money coming to the Kenya to get those returns and selling the United States dollar because to enter the Kenya market, you should sell the dollar and you should buy the domestic currency. So in any case, there are two triggering points for the currencies, the trade balance and the interest rate differential or interest rate spreads. Now, the second point here is that I download the time series from the, let me share my screen. First of all, I will show my Excels to you. Here it is. Please look at this Excel. I think everybody can see my Excel now, right? And here I have spot returns, and here I have the time series for these returns. Do you see the currencies? Yes. The XY, Euro USD, USD Japanese Yen, GBP USD, all these major currencies. Please look at this one. United States dollar against the Canadian dollar. United States dollar, Swedish krona, or Swiss franc against United States dollar. Now I'm checking and I'm taking the biggest one that we speak about it, approximately 80% coming from Euro, Japanese Yen, and GBP, right? So for this time frame, from 2015 now, for 10 years, I'm checking what is happening. How is the DXY fluctuating around the world? And this is the highest value, 115, and lowest value around the 90 for the United States dollar spot exchange rate, and 125 for USD, Euro USD, and the lowest value 0.95. And at the end of the COVID-19 crisis, when the Russia invade the Ukraine, there's an attack, the occupation of the Ukraine by Russia decreased the risk appetite all around the world, and the euro losing strength and converging to 0.95, meaning that approximately 30% depreciation of the euro against the United States dollar here, as you see. But there are another different story here in the Japanese yen. Why? Because compared to the rest of the world, there is a problem in Japan right now. It is the inflation problem. Everybody all around the world trying to decrease their policy rate because they are fighting with inflation and they are good this disinflation process. And in United States, Euro or United Kingdom, the inflation almost 9% with the, how can I say this, with the COVID-19 conflict. But right now it is just 2-3%. But in Japan, the inflation is increasing. This is dramatic. Rest of the world is decreasing the inflation, but the Japan is, there's a problem in Japan. The inflation is increasing. To fight with this inflation, the Japan Bank of Japan, the Central Bank of Japan, increasing the policy rate. And United States started depreciating because what we say, if you increase your interest rate, lots of money come to your country and your domestic currency appreciates, right? So here, as you see, the appreciation of the Japanese yen compared to the United States dollar, there's a different story there. For the GBP, it is stable currency. 125 is the average of the 15 years, approximately 10, 15 years. And as you see, we are just above the 125 and we are around 135. And GBP is getting strength because, please look at Euro getting strength, GBP getting strength. Why? Because Trump closing the United States to the rest of the world. He is putting lots of tariff, tax, lots of regulation, and the dollar losing strength compared to the rest of the world. As you see, the major currency is getting strength here, except the Japanese yen, as I say, because they are increasing their interest rate. And here you will see the global currencies all around the world. This table, please look at this one. The black point showing the developed market currencies, and the orange one showing the emerging market currencies. What is this calculation? 2025 year to date, meaning that from January till June, you will see their movement against the United States dollar. And this is USD index, the XY. This USD index meaning this one. Okay. This is your USD index. Okay. This one, your USD index. And this is decreasing approximately 4% year to date. Yes, this is normal. From here to here, you decreased, right? From 105, now you are around 100, meaning approximately 4% decrease in the United States index. And here you will see, for instance, from emerging market, Brazilian real increase approximately appreciate against the United States approximately 7%, or euro 5%, Japanese yen approximately 4%, Great British pound approximately 4%, Swiss franc 3.9%, Australian dollar just around 1%, Malaysian rupee, as you see here, just around 1%, Thailand, Mexican peso just 1%, Canadian dollar 1%, China renminbi here. And what are the dramatic case for three countries? They are depreciating against the United States dollar. Taiwan dollar, Indonesian rupee, and the Turkish lira. These three countries in emerging market, despite the dollar losing strength all around the world, these three countries depreciating against the United States dollar. This is another dramatic result of this policy, because you know that these countries also in the disinflation process, and despite lots of struggle that these countries putting effort on those challenges, these, for instance, in Turkey, the official interest rate approximately 46%. Despite its higher interest rate, because inflation is really high, market is pricing that Turkish central bank will not be successful to fight with the inflation as the market expects, and the Turkish lira depreciates. On the right hand side, please look at the definition. The black line showing the dollar spot index, this one. Okay, the black line is this one here, this one. And the orange one, orange line, showing US 10-year treasury yield minus developed market 10-year treasury yield or government. And as you see here, they are almost exactly have a same volatility and movement. If the dollar spot index losing strength, meaning that the United States giving less interest rate, right? Because interest rate spread is decreasing and dollar losing strength as well. So if you understand this chart, what we mean by interest rate spread and how it is affecting the dollar spot exchange rate, you can earn the money from the international FX market. Okay. Now, if you understand this global currency movement and their appreciation and depreciation story, let's continue with what can be other triggering point for some specific countries. For instance, for the Australia is one of the biggest commodity exporting economies. So commodity price in the world directly affecting their currency, right? Australian dollar, United States dollar parity. Because if the commodity price is decreasing, Australian dollar will depreciate because Australian dollar is one of the biggest producer of commodity and one of the biggest exporter of the commodity products to the rest of the world. As you see here, this orange line on the left-hand side, please look at this left-hand side. This is commodity price index. And this orange line going like this. If commodity price is increasing, Australian dollar getting strength because Australia exporting commodity, right? They are earning Australian dollar more. For that reason, their currency is appreciating. And for the short-term rate and FX rate, please look at this spread. This is basis point. Basis point meaning 1 point in 10,000. Okay, this is called in international financial market as basis point. For instance, if you divide 200 to 10,000, you will get that basis point. Okay. And here, 2-year treasury yield spread. This is difference, bond yield difference. And this is representing in the basis point on the left-hand side. And on the right-hand side, again, we have Australian dollar, United States dollar parity. So what can I say? If the short term also moving in the positive direction of the Australian 10-year or 2-year treasury yield, Australian dollar getting strength against the United States dollar. The same story. So short term or long term yield. If your interest rate increasing, your domestic currency will appreciate. This is the basic story behind the screen. And now, I took the Bloomberg charts today from my investment banking account and I requested what can be reflected and how can we show what is the direct effect and what is happening all around the world against the small countries or major countries, biggest countries spot exchange rate. And the range is yesterday than today, meaning that 1 day return I'm trying to reflect here. Please look at the best spot returns. Zambian Kwacha, South Korean won, Israeli shekel, Norwegian krona, Sierra Leone, Czech koruna, Kazakhstan tenge, Australian dollar, Chilean peso, Thai baht, Argentinian peso, Mexican peso, or Nigerian naira today are the best performing currencies against the United States dollar. What are the worst just for 1 day are this one, like Tunisian dinar, Moldovan leu, or Bhutan nuptrim, Indian rupee, or silver is another, even it is a commodity, silver is a commodity. It is like a currency. It is a tick data. You can see the challenges and changes in the prices of the silver every second. For that reason, I reflected this chart to show you just in 1 day what is happening in best spot returns. But if I change this spot return and for the basket of the major currencies, please look at this chart. This best spot returns for 1 day for all currencies. Okay, I'm taking all the country in a basket and I'm checking what is happening in 1 day. But if I take this currency for major currency and change my scenario for 5 day, and in the basket is just major currency against United States dollar for 1 week. What is the performance? Let's look at it. Except the Taiwan dollar, almost all major currencies appreciating against the United States dollar. Why? The Trump wants this, right? Trump's policy is trying to depreciate the United States dollar. This is the United States new administration policy, and United States dollar all around the world losing strength in their currency, except the Taiwan dollar. Okay, for the major currency. And let's change another scenario. Let's look at an alternative scenario. What's happening here? Now, I'm checking again the major currency, but now my scenario taking the time frame for 1 month. Now, even Taiwan dollar is not depreciating. All currency, all major currency around the world for 1 month frequency fighting the United States dollar. The biggest earner, the biggest winner from this fighting is the South African rand, approximately 3% appreciation. Norwegian krona 3%, Taiwan dollar 3%, South Korean won approximately 2.5%. The least one is the Brazilian real, as you see, 0.45. Okay, or euro during 1 month appreciate against United States dollar around 1%. Now I can change my currency and I want to see that whether these results, because this is a dramatic result, almost all currency appreciating. And I want to be sure that whether this is a result of an economic output, economic result, or this is a policy response, or this is a policy choice, and I want to increase my time frame because Trump comes to power at the beginning of the 2025. Just 6 months he has been in the power and administration, right? So if I increase what is happening in 1 year return, I can see the real return before the Trump as well. Now I'm changing my scenario. Please look at the scenario now. Again, measure currency, again against the United States dollar, but now I'm taking 1 year time frame and the result is changing, right? If I take 1 year performance against United States dollar, Mexican peso depreciate approximately 7%. Brazilian real approximately 6%. New Zealand dollar depreciate approximately 2.5%. And Australian dollar 2.4%. What is the best performance during 1 year is Swedish krona and Swiss franc. These are two. Please look at the basket again. Swedish krona and Swiss franc also in the basket of the XY currency, right? These currencies are also calculating what is happening exactly in financial market and FX market. And if I take a look at for 1 year performance of these currencies, these two biggest reserve currency also has a really good power while fighting the United States dollar because they appreciate approximately 8% or 9% for the Swedish krona. And the break-even point for South Korean won, just 1%. And the euro, almost the biggest currency after the United States dollar, approximately 5% appreciation against the United States dollar. This is a good return. Why? Because if you put your money in the euro, okay, what is your spot return? It is 5%. What is the inflation in euro area? It is just 3%. And you have a positive 2% real return, right? Please look at this one. I'm making a calculation here. Give me 1 second, please. I think everybody see my screen here. I have a white table here. Okay. Euro USD. What is its performance for 1 year? Approximately increase for 5%, right? And by the way, these are nominal returns, okay? Nominal returns, nominal. But I want to see my purchasing power, right? Real purchasing power. What is real value. The real value is this one. Nominal. Please don't move your mouse on the screen. Please. Nominal minus inflation is my real return. So if I put my money in the United Euro USD parity, what is my nominal return? It is approximately 5%, right? What is the inflation in Euro area? It is around 2%, 2.5%. So what is my real return? 2.5% real purchasing power if I put my money at the beginning of the year for Euro USD parity. Okay, I'm not losing money. In real terms, my purchasing power is increasing if I buy the Euro USD in the Euro area. Okay, now let me again turn to my presentation. And as you see here, this is 1 year performance. And now I will increase my time frame about what can be happen for the next couple of years, because I don't want to see just the spot return. I want to see the real return in financial market, because I want to try to decide what can be happen in financial market if I take a chance for these values. And please look at this one. Value for forecast spot returns. If I make a forecast, what can be happen for the third quarter? Please look at the third quarter of the 2025. What can be happen for the major currencies? Almost all of them is appreciating. Japanese yen, Australian dollar, Norwegian krona, euro, and Swedish krona. These biggest major currencies appreciating. And other currencies for the next quarter is depreciating against the United States dollar. Even New Zealand dollar, Danish krone, Singapore dollar, Swiss franc, British pound, Taiwanese dollar, Canadian dollar, even Mexican peso. The market is pricing that Mexican peso depreciate approximately 3% against the United States dollar for the third quarter. This is the market pricing mechanism for this value and appreciation and depreciation. And let's continue with what can be happen now for the last quarter. Okay, my term is now for the last quarter of the 2025. If I see, if I put my money in these major currencies, what can be my return at the end of the session for 2025? Approximately from here, 6 months later, what can be my return in the financial market if I buy these currencies? 6 months from now on. So let's check it. Here, as you see, Japanese yen, Swedish krona, Australian dollar, New Zealand dollar, Danish krona, Swiss franc, all these currencies getting strength, appreciating against the United States dollar during the 6 months. But what is happening Mexican peso? It is depreciating furthermore, because please look at it here. For the third quarter, the depreciation is 3%. For the whole of the year, depreciation is approximately 4%. For Brazilian real, for South African rand, almost all these emerging markets is depreciating. So what is the message from this picture? The message is this: during 6 months from now on until the end of year 2025, the developed market economies, major currencies will appreciate against United States dollar, and emerging market currencies will depreciate against the United States dollar. This is the basic message you can get from this picture, because we can understand that this basic structure, the pricing mechanism, tried to tell us that this depreciation in emerging market will go furthermore even in the fourth quarter of the 2025. And now, please look at now, not the emerging market, but please take this one. This is forecast spot return. Okay, this is forecast spot return for major currencies for the last quarter of 2025. And now, if I take forecast total return, please look at this one. This is spot return. Okay, this one is spot return for the 2025 last quarter, or this is for the third quarter, but for the spot return. If I take this total return, what we mean by total return? Total return trying to calculate the interest rate return and the currency return in this domestic and major currencies. And now, if I take the total return, now the case is changing. Please look at this one. What is the third quarter saying? Spot return, Brazilian real will depreciate, right? In the third quarter, in the spot return, 2%. But if I take the total return for the Brazilian real, it is appreciating, right? Even for the, where is it? Australian dollar, all this biggest currency is appreciating if I take the total return. Why? Because total return also calculating the interest rate return and FX return in total, not just the total spot FX return. They are taking into consideration those interest rate return and spot FX return at the same time. But even in this case, in the third quarter, the South Korean won depreciating, Swiss franc depreciating, and Canadian dollar depreciating. But the biggest currencies, even in emerging market, even in advanced economies, appreciating against the United States dollar in the third quarter of the 2025. But my ultimate question is here as this one. Let me check it. Here, as you see, the forecast total return for the end of the year. Okay, the total return, what will happen for the last quarter, for the during the year? If I put my money for these major currencies, what will be my value, nominal value in total return against the United States dollar during the 6 months? As you see, except the Taiwan dollar, almost all currencies around the world, Brazilian real, Australian dollar, Norwegian krona, Japanese yen, euro, British pound, every currency getting strength and appreciating against the United States dollar. Please look at the Brazilian real here, 4% increase. Please look at the Australian dollar here, 4% increase against the United States dollar.